You think your $20 AI subscription is the deal of the century. It isn't. It's a trap. A serious power user running Claude Code actually costs $15,000 a year to serve at real unsubsidized compute prices. You're paying $1,200. The gap, $13,800, is being quietly covered by venture capital money that is starting to run out. You're living inside the AI version of the Uber moment, a temporary, deliberately manufactured illusion designed to get you completely dependent on a product before the real price tag finally lands. And when the investor patience runs out, the tools you've rebuilt your entire workflow around will either disappear or send you an invoice that looks nothing like what you signed up for. I'm Jimmy, and this is Finance Misfires. The economics of AI are broken, and most people won't realize it until the invoice arrives. Here's where the math starts getting uncomfortable. A serious Claude Code power user runs through roughly 10 billion tokens a year. Tokens are the fundamental unit of AI computation. Every word read, every word written, every decision process consumes them. At standard API pricing, no discounts, no promotional rates, just raw compute costs, those 10 billion tokens run approximately $15,000 annually. That's the real unsubsidized price of what you're actually consuming. That same user on a flat-rate max subscription pays around $1,200 for the entire year. That's a 92% hidden subsidy on every single session, every prompt, every code block, every late-night debugging run. The analogy is almost too clean. Imagine walking into a dealership, picking out a $15,000 car, and being told your total is $1,200 because someone else is covering the rest. You'd want to know who and why. According to OpenAI's own financial projections leaked to the information, the company is on track to lose $14 billion in 2026, not revenue losses. A $22 monthly subscription covers approximately 1.7% of what an active power user actually costs to serve. You are not a customer, you are bait. Every prompt typed, every workflow automated, every business process rebuilt on cheap AI. It's all being paid for by patient investor capital, betting that by the time the real bill lands, nobody will be able to function without the product. If this setup feels familiar, it should. Because we've watched this exact movie before and we know precisely how it ends. Cast your mind back to 2014. A black SUV would pull up outside your apartment in 3 minutes. Driver was professional, car was spotless, trip to the airport cost $11. You'd sit in the back wondering how any of it possibly added up. It didn't. And that was entirely the point. For the better part of a decade, an entire generation lived inside what economists later called the millennial lifestyle subsidy. Venture capitalists poured money into ride-sharing, food delivery, co-working spaces, and meal kit services, deliberately setting prices below cost to crush legacy competitors and hardwire new consumer habits. The plan was market domination first, profitable pricing second. Uber's own numbers tell the story cleanly. In 2022, Uber kept roughly 32 cents of every dollar a rider paid. By 2024, that figure had climbed to approximately 42 cents. Drivers got a smaller cut. Riders paid more. The company eventually posted a profit. The habit was locked in. The subsidy ended. The price adjusted. Now the exact same playbook is running in AI. Same investors, same logic, same pricing memo sitting in a drawer, somewhere waiting for the right quarter. Industry analysts are projecting consumer AI subscription tiers to roughly double in price over the next 2 years. Anthropic has already rolled out rate limits, quietly nudging power users toward higher-priced plans. Google is testing premium-only Gemini features that were previously included at no additional cost. A 100% price hike isn't a rumor or a worst-case scenario. It's already penciled into the calendar. Enterprise contracts are following the identical curve. Custom deals signed in 2024 are being quoted dramatically higher at 2026 renewals. Same product, multiples of the original price. Take it or leave it. AI executives keep saying the same thing. Compute is getting cheaper every year. Unit economics will work out over time. Each individual word an AI generates is genuinely less expensive to produce than it was 18 months ago. That part is technically true. Here's the part they leave out. Modern agentic AI workflows burn through anywhere from 5 to 30 times more tokens than simple chat sessions did 2 years ago. When you ask a code assistant to fix a bug, it doesn't write 50 words and stop. It spawns subtasks, rereads your entire file structure, writes multiple drafts internally, runs background tests before surfacing any answer. A single request can consume hundreds of thousands of tokens before a single word appears on your screen. A model might be cheaper per word than before, but it's generating dramatically more words per request. The total bill is climbing in one direction, upward. This is the token tax, and it's already bankrupting scrappy AI startups burning through seed rounds. But the pricing problem is only one side of this. The other side is structural, and it's eating the most profitable business model in the history of the internet. For 25 years, Google ran the most reliable profit machine in the history of American business. The model was brutally simple. User types a query. Google returns 10 blue links. Total cost, a fraction of a cent. Revenue from the ads next to those results, multiples of that fraction, one of the great financial margins of the modern era. Now Google is rebuilding that entire system on generative AI. A single AI-powered response costs significantly more to produce than a traditional keyword search. Multiply that across billions of daily queries and the arithmetic becomes catastrophic. And the advertising model breaks simultaneously. When AI hands you the answer directly, nobody clicks the links. Advertisers stop paying for placements nobody sees. Google ends up serving more queries than ever, at higher cost than ever, generating less revenue per query than at any point in its modern history. This is the trap every technology incumbent eventually faces. Sit still while a competitor builds the future around you, or cannibalize your own cache engine and hope you build revenue on the next platform before the old one fully erodes. Google, Microsoft, and Meta have all chosen option 2. Nobody can prove that's right, and everybody is already in too deep to reverse course. Here's the part that should make every investor paying attention genuinely uncomfortable. Microsoft publicly commits $13 billion into OpenAI. Headlines are dramatic. Stock prices move. Read the fine print, and a completely different picture emerges. A significant chunk never hits OpenAI's bank account as cash. It arrives as Azure Cloud credits, a gift card redeemable only at Microsoft's own data centers. OpenAI records it as capital raised. Microsoft logs the cloud usage as revenue. It's an investment and a sale happening through the same transaction. OpenAI has separately committed to spending up to $250 billion on Azure services. Layer NVIDIA on top. NVIDIA commits to OpenAI. OpenAI buys GPUs. NVIDIA posts record revenue. The same loop runs across Oracle, CoreWeave, and AMD. Almost no real new money changed hands. It just got assigned a different label at each stop. The technical term is round tripping. In Silicon Valley, they call it a strategic partnership. And it's how AI companies post record revenues every quarter while losing billions in actual operating costs. Here's the number that should stop everyone cold. In 2025, Big Tech was projected to spend somewhere between $320 and $400 billion on AI infrastructure. Data centers, GPUs, cooling systems, power delivery, entire electrical grids being reinforced just to handle the compute load. Updated forecasts for 2026 push that figure toward $500 billion. Total global consumer spending on AI services during the same period, approximately $12 billion according to Menlo Ventures' State of Consumer AI report. Hundreds of billions flowing out, 12 billion coming in. The gap between those two numbers is the size of a mid-sized country's entire economy. And it's being filled not with revenue, but with corporate bonds, structured credit, and private lending instruments. Meta alone raised $30 billion in bond markets in late 2025. Microsoft has signed a 20-year power purchase agreement to restart 3 Mile Island. Google has partnered with Nextera Energy to reopen nuclear facilities. These commitments don't quietly disappear if AI revenue underperforms. The contracts run for decades, regardless of what the income statement says. and the hardware itself has a brutal depreciation curve. A high-end NVIDIA GPU powering this entire build-out has an effective life of 1 to 3 years before the next generation makes it commercially obsolete. New GPU generations are hitting the market roughly every 18 months. A data center full of 3-year-old chips is in industry terms dead weight. The AI bubble will leave behind warehouses full of obsolete silicon locked inside 20-year power contracts and concrete shells in remote locations. Utilities will pass higher electricity costs directly to American households for decades, regardless of whether the AI revenue ever actually materializes. While Wall Street was counting the billions, users were already noticing something had quietly changed. Most users have already felt the product getting worse. They just haven't connected the dots yet. An AI assistant that used to nail your code in a single pass now forgets your project halfway through. A chatbot that used to write 5 paragraphs now cuts off at 3. An image generator that used to produce clean results in 30 seconds now spits out something with 7 fingers and quietly asks if you'd like to upgrade. Nobody is imagining this. The product is genuinely deteriorating, so why doesn't anyone say so officially? When the underlying numbers stop working, the easiest lever a provider can pull is quietly degrading the service. Message caps that refreshed every 5 hours now refresh every 8. Default models get swapped from flagship versions to smaller, cheaper alternatives without announcement. Memory features get quietly rolled back. Advanced reasoning gets locked behind a higher price tier. Reddit threads across every major AI tool community are full of users swearing their assistant has gotten noticeably lazier. Engineers are posting side-by-side output comparisons, showing visible quality degradation versus 6 months earlier. Companies almost always deny it. Sometimes they release carefully selected benchmarks, clean prompts, controlled conditions, optimized scenarios designed to show the product at its absolute best. It buys time. It doesn't fix the structural problem. And then comes the final phase. According to CB Insights data, roughly 40% of AI startups launched in 2024 have already been shut down or acqui-hired, sold for cents on the dollar to larger players who wanted the engineering talent and shut the product down immediately. These weren't garage experiments. These were companies that closed series of rounds with serious institutional investors. They had revenue, paying customers, and glowing profiles in the tech press. Within 18 months, lights out. The reason is almost always identical. The cost of API usage from foundation model providers completely wipes out any margin the startup could realistically charge. A startup wrapping a polished interface around GPT-4 might charge $50 a month. The API usage that same customer generates costs the startup $80. Every active user is negative revenue. The better the marketing, the faster the bleed out. When foundation model providers release new native features, they routinely kill 10 startups overnight. ChatGPT launches native voice mode. A dozen voice agent startups that closed series of rounds last quarter are instantly obsolete. Claude releases native PDF reading. An entire crop of document processing tools becomes worthless in a single product update. Here's what this all adds up to. AI in 2026 is on a structural path to becoming a luxury product, not a democratized tool. Cheap versions trained an entire generation to need it. The expensive version is the only one the balance sheets can now support. Large enterprises that can absorb the new pricing will lock in their competitive advantage and pull further ahead. Freelancers, small businesses, and the early adopters who created the cultural momentum around AI, the ones who built the buzz and rebuilt their workflows from the ground up, will be priced out first. The productivity assumptions baked into business plans, written in 2024, will not survive contact with 2027 pricing reality. A dot-com bust took roughly 2 years from peak to trough. The AI infrastructure bubble carries more leverage, more concentration, and more long-term debt obligations than anything the dot-com era produced. When it tips, it can move in months, maybe weeks. The tools millions of Americans rely on every single day were never as cheap as they appeared. They were being propped up by investor capital that is quietly starting to dry up. The cheap AI age fooled an entire generation into rebuilding their working lives on top of it. The bill simply hasn't arrived yet.
This is exactly what Finance Misfires is built to cover.
If this changed how you think about the AI tools you've built your workflow around, drop a comment telling me which platform you're most dependent on and least prepared to pay 10 times more for. Because that's the one that has the most leverage over you. Share this with someone who thinks their $20 subscription is a steal. It is right now. That's exactly the problem. Subscribe to
Finance Misfires
for more breakdowns like this. The structural math underneath the hype, the invoice hiding behind the deal. I'm Jimmy. The subscription price felt like a deal. It was always an invoice with a delayed send date. I'll see you in the next one.